In 1929, the world stopped. Banks collapsed. Stocks crashed. Millions of people lost everything. It was called the Great Depression, the biggest financial disaster in modern history. But here's the strange part. Almost 100 years later, we keep making the same mistakes. The dot-com bubble, the housing crisis, crypto, AI. Why do these bubbles always repeat? And more importantly, what can we learn before the next one bursts? Let's find out. The story really begins in the 1920s, a time of jazz, flashy cars, and crazy optimism. America had just emerged victorious from World War I. Factories were booming, churning out new products. Incredible technologies, like the radio, airplanes, and household electricity, were changing everything. It felt like the good times would never end, and at the center of all this excitement was the stock market. It became a national obsession. Everyone, from farmers in the heartland to waiters in the big cities, started buying stocks. But here's the key detail. They weren't just investing their own money. They were borrowing money to invest even more. This is called buying on margin. Imagine you have $1,000, but you borrow another $9,000 to buy $10,000 worth of stock. If the stock goes up just 10%, you've doubled your initial investment. It's an intoxicating feeling, and it made people feel incredibly rich. Until, of course, it didn't. By October 1929, stock prices had been soaring for years, climbing to levels that had no connection to the actual profits of the companies they represented. An unshakable belief had taken hold. Stocks would only go up. Then, on October 24th, it started. A few cautious investors began to sell. Then a few more. That trickle turned into a flood, and panic spread like wildfire. In just a few days, the entire market collapsed. Billions of dollars simply vanished into thin air. The dominoes began to fall. Banks, which had loaned out so much money for stock speculation, failed overnight. People who had trusted the banks with their life savings rushed to withdraw their cash, only to find the doors locked and the money gone. Factories shuttered their gates. Unemployment skyrocketed to an unthinkable 25%. Families couldn't afford food. Lines for bread and soup stretched down city blocks. It felt like the world had ended. This was the Great Depression. But it wasn't just a case of bad luck. It was a perfect storm of human nature, greed, fear, and a stubborn refusal to see the truth. You see, financial bubbles all follow the same predictable pattern, over and over again. It starts with excitement. A new idea, a new technology, or a new market appears. Think of the internet in the late 90s, the housing market in the mid-2000s, or even AI today. People see a massive opportunity, a chance to get in on the ground floor of something revolutionary. Then comes the euphoria. Prices rise, and they rise fast. The media is filled with stories of ordinary people becoming millionaires overnight. The fear of missing out kicks in, and everyone wants a piece of the action. People start saying those famous last words. This time is different. That's when greed takes over. Borrowing increases dramatically. Everyone starts to think they're a financial genius because their investments only go up. The concept of risk seems like a distant, irrelevant memory. But eventually, warning signs appear. A few experts might raise concerns, or prices might dip slightly. This is the denial phase. No one wants to believe the party could be over. They doubled down, convinced it's just a temporary blip. And then, suddenly, comes the panic. Prices drop sharply. The stampede for the exits begins. But it's too late for most. This is the crash. Finally, we hit the depression phase. Reality sets in. Fortunes disappear. The overwhelming greed is replaced by crippling fear. And then, after a few years of pain and rebuilding, people forget. The lessons fade, and a new generation is ready to believe that this asterisk time, it really is different. A new bubble begins to form. It's like watching history play on a loop, not because the world changes, but because human psychology doesn't. So, what are the timeless lessons we can take from the Great Depression? First, don't just follow the crowd. When everyone is screaming buy, it's often the best time to stop, take a breath, and think for yourself. Groupthink is the fuel that inflates bubbles. Second, real value matters. Trends come and go, fads fade, but companies with strong fundamentals, real products, real profits, and solid balance sheets are the ones that survive the storms. Third, easy money creates danger. When borrowing is cheap and credit is loose, it's easier for speculative bubbles to grow, and grow fast. Be wary when it seems like everyone is getting rich on borrowed cash. Fourth, and perhaps most importantly, remember that emotions move markets. Greed inflates them, and fear crashes them. The cycle never truly ends unless you can learn to control your own emotions and make rational decisions. And finally, learn from history before you're forced to repeat it. The people of 1929 didn't have the benefit of hindsight. They couldn't see the crash that was coming. We can. We've seen this movie before. The Great Depression changed everything: global economies, politics, even our culture. But its biggest lesson wasn't just about money. It was about memory. Because every single time a new bubble starts to inflate, you will hear people say, "This time, it's different." But it never is. The names on the ticker might change. The technology might seem brand new, but human nature doesn't. Learn from the past so you don't repeat its mistakes. If you found this story valuable, subscribe for more history that helps explain the markets. Let's learn from every crash, every boom, and every bubble, because the next one might already be forming. Thanks for watching.